Good day. This is Reyhana de Campong,
Lacey Sarmiento,
Yanessa Tumambing,
and Gab, and we will be presenting our financial analysis of Pepsi-Cola Products Philippines Incorporated.
PCPPI is a stock corporation that has been registered with the Philippine Exchange Commission since March 8, 1989.
The company primarily ventures on a wide range of carbonated soft drinks, non-carbonated beverages, and snacks offered in various package types and sizes. These products mainly cater to a wide range of customers. PCPPI also provides employment through its extensive distribution network, as it has established 14 manufacturing facilities across the nation, serving at least 700,000 outlets.
So first, we evaluate the entity's financial statement using the common size analysis. In applying this method, it can be deduced that the cost of goods sold is 80.63% of the net sales for the year, which means that PCPPI has incurred more costs directly related to producing goods intended for sale. A high cost of sales for the year can greatly impact the gross profit and net operating income of the company. Further, most of the cost of goods sold is attributable to materials and supplies used, which consist of raw and packaging materials, finished goods, and work in process. Carrying and ordering costs generated the second highest percentage, but are kept at a minimum throughout the 3 years.
On the other hand, the common size analysis for the balance sheet shows that 42.56% of the total assets comprise property, plant, and equipment. These fixed assets, which are the company's capital expenditures, serve as long-term investments for PCPPI's future and significantly impacts its financial position. This line item is also crucial for potential investors in analyzing how the firm raises funds for its projects. Meanwhile, deferred tax assets, which is 0.39%, have the least percentage in the composition of total assets.
The company's short-term obligations, which are accounts payable and accrued expenses, have the highest percentage composition. This means that the PCPPI had purchased a significant amount of goods on credit and had recognized expenses not yet paid for the year. On the contrary, the remeasurement losses on net defined benefit liability represent negative 1.29% of the total liabilities and shareholders' equity.
The group applied a simple base year trend analysis, with 27 as the base year. And looking at the changes in the overall total comprehensive income, it can be seen that there was a considerable decrease from 27 to 2018 of negative 123%, leading to a net loss in 2018. This is expected because of the decrease in operating profit and the increase in finance and other expenses. Focusing on the operating profit percentages, it can be deduced that the notable 103% decrease is due to the increase in the cost of goods sold, because net sales had increased and operating expenses had decreased during this period.
As for the trend analysis of the entity's balance sheet, it can be observed that inventories have the highest increase from all assets for both 2018 and 2019. Having these high percentages can be quite alarming for the company, because this generally means that it is struggling to turn over inventory and generate sales. Carrying excess inventory has significant costs because it has to spend more on labor to manage it, space to hold it, and insurance to protect them from loss or damage.
Further observations show that the long-term debt, net of current portion, has the highest percentage increase for both 2019 and 2018. It is possible that this long-term debt increased because of its new capital-intensive projects, and since this type of debt requires a slightly higher interest rate, it usually takes longer time to pay the principal with interest. On the other hand, it is also evident that there has been a major decrease in income tax payable in the two latter years.
From 2017 to 2019, the entity had a positive FCFF, which indicates that it was able to generate sufficient cash flows to support its operations, and that there were available cash flows to be distributed to its investors. There was a considerable decline of FCFF in 2018, which may be attributable to the entity having more cash outflows than inflow, exemplified by the substantial decrease of its current liabilities and the significant elevation of its current assets. Having such a significant drop as well in FCFF means that the company would have to finance its future operations through debts and equity.
The lower free cash flow in 2018, however, does not generally mean that the entity entirely mismanaged its assets. In fact, the entity had allocated more of its funds to long-term investments as the capital expenditure on both years increased. These investments will enable them to earn a high rate of return in future operations. This positive FCFF is also an indication that the entity was able to recover its losses in the previous year and had an adequate cash flow for future activities.
In the case of Pepsi, its FCFE is higher compared to its FCFF for the past 3 years. This was a result of the entity's substantial issuance of more debts to finance not only its operations, but also to fund its capital expenditures and current debts. Such scenarios are evidenced by the higher proceeds received from both short-term debt and long-term debt more than the repayment. With the additional acquisition of debts for the 3 years, it is expected that the entity will pay more interest expense for the succeeding.
Upon analyzing the trend of the liquidity ratios, it is noticeable that both the quick and cash ratios have been steadily increasing, which is a good sign for the company as it indicates that they are getting better at being able to pay off its short-term obligations without relying on its inventories. For the current ratio, there was a notable spike in 2018, which could be due to the significant inventory increase of the company, notable in the previous trend analysis.
It is observable that the accounts receivable turnover ratio and inventory turnover ratio have been decreasing since 2017. A low accounts receivable turnover ratio might be due to poor collection process, extension of credit to non-credit worthy customers, bad credit policies, or excessive amounts of bad debts. Thus, this implies that PCPPI should reevaluate its credit processes in order to ensure the timely collection of receivables. Additionally, a low inventory turnover ratio can mean that the company is holding too much stock and is not efficient enough in converting these items into sales. This can be the result of extra production of safety stock, returns from a prior period, or fulfillment of contractual stocking agreement. Slower moving inventory may be detrimental for the company because this increases the risk of loss, damage, or expiration.
As for the accounts payable turnover ratio, it is evident that it increased during 2018 but decreased in 2019. The increase of this ratio's level may be due to suppliers demanding quick payments, PCPPI taking advantage of discounts, or its efforts in improving credit rating. On the other hand, a decreased AP turnover ratio indicates slow payment to suppliers for purchases on credit. This may be due to cash flow problems or financial distress. However, this is not always the case. It is possible that PCPPI has successfully managed to negotiate better payment terms which allow less frequent payments without penalty.
In relation with the previous analysis, the days sales outstanding and days inventory outstanding have both increased since 2017. An increase in DSO illustrated that the company is experiencing a rough time collecting payments after sales have been made, which may result in cash flow problems. Meanwhile, an increase in DIO may be interpreted as a difficulty for PCPPI to quickly turn its inventory to sales, which can be due to poor sales performance or purchase of excess inventory. Having a significant amount of idle inventory can negatively impact the company as they may soon become obsolete or unsellable.
A spike in DPO is generally advantageous for a company if it plans to use the available cash for short-term investments. However, it is more appropriate to analyze this ratio from a long-term perspective, where PCPPI has to also think of maintaining good relations with its suppliers and creditors.
In terms of asset management, both the fixed asset turnover ratio and total asset turnover ratio have increased within 3 years of comparison. An increase in fixed asset turnover ratio indicates that the company's management is efficiently utilizing its fixed assets. As for the increase in total asset turnover ratio, this shows that the company is using its assets effectively to generate sales. This also gives investors and creditors an idea on its management and production processes.
Looking at this graph, we can see that the majority of the company's assets are funded by debt, the purpose of which is to refinance the company's short-term loans and capital expenditures. As this has been consistent for 3 years, we can assume that the company has chosen to be highly leveraged, which consequently means taking on a high level of risk. Its debt to equity and debt to capital ratios also manifest the same idea previously, as on average they have 1.76 pesos of debt for every equity and 40% of their capital is funded by debt.
However, the company's equity multiplier reveals promising returns for the company's use of debt, as it shows that it was able to more than double the assets provided by equity for all of the 3 consecutive years. That said, we can say that their choice of taking on a high level of risk also yielded them good results.
As for the profitability ratios, it can be analyzed that the entity was more profitable in the earliest year than in 2018 and 2019. Its gross profit margin significantly declined in 2018, which could mean that at that year, the company was unable to control the inventory costs and did not impose a high profit upon selling it to customers. The company as well might have excessively manufactured its products and was unable to promptly sell them.
The ROA, ROIC, and the BEP ratio, on the other hand, had a similar V trend for the past 3 years. While the ROE had a narrower V shift as it declined by 7% in 2018, meaning that the company did not efficiently manage its equity and was unable to put a positive return on the shareholders' wealth at that time. The constant upward trend, however, from 2018 to 2019 signifies that the company has improved its profitability and was able to recover the losses from the previous year.
The firm has also paid most of its earnings as dividends to its shareholders, represented by the dividend payout. Such occurrences appeal more to the company's current shareholders and could even encourage potential investors to invest in the entity.
The dividend yield ratio and the market book ratio had only gradual changes as opposed to the abrupt shifts in the price earnings ratio. This means that the investors view the firm's performance relatively the same and that the entity continuously pays 2 to 3% of the stock market price as dividends. There was also notable growth in the willingness of investors to pay a high price in 2019. Potential investors are much more stimulated to provide capital for the entity that can be an advantage of the entity to further enhance its operations.
After evaluating PCPPI's financial ratios individually, let us now discuss the relationship with one another through the DuPont analysis. During 2019, the company's ROE increased as compared to the negative return in 2018. This is mainly due to the significant change in ROA, since the equity multiplier only had minimal adjustments during the year. The increase in ROA can be associated with the net income for the year, which in effect also increases the company's net profit margin. Even though the cost of goods sold and expenses of PCPPI were higher for the year, its operations still resulted in an income because of the higher sales generated. Consequently, this led to an increase in total asset turnover, which also contributed to a higher return on assets for 2019. Compared to industry averages, the company's ROE and ROA are considered poor. The same is true for most of its profitability and activity ratios, and both of which provide a glance at the operations and financial management of the company that overall have greatly affected the ROE.
Now, we will move on to the benchmarking analysis. Some ratios of the industry were not available and thus were computed by averaging that of 4 leading companies in the same industry. In comparing these ratios, a metric was applied. The industry average was divided by 5 and multiplied by 4 to get the lower limit, or multiplied by 6 to get the upper limit.
As we can see, the liquidity ratios of PCPPI indicate a good current ratio, yet does not have the same evaluation for both quick and cash ratios. This stems from the number of inventories the company has, which has been a recurring observation in previous analysis. The poor cash ratio of the entity indicates that the company would have difficulty paying off its short-term obligations without relying on inventories and receivables. But this could also mean that the entity has been investing more of its cash on other assets for future growth of the company compared to that of the industry.
On the other hand, half of the activity ratios got a poor evaluation, while the other half were relatively similar with other companies within the industry. poor results in accounts receivable and inventory turnover indicate that PCPPI is not efficient enough in collecting receivables and converting inventory to sales compared to similar businesses. As mentioned in the previous interpretations, these may be due to the company's poor credit policies and extra production of safety stock, respectively. In effect, substandard results were also displayed for day sales outstanding and days inventory outstanding. As for the accounts payable turnover ratio and days payable outstanding, it was able to meet the industry's average because the company managed to quickly perform its obligations to its creditors within the credit period. Meanwhile, a standard evaluation for the total assets and fixed assets turnover exhibits that PCPPI efficiently utilized these assets to generate sales in relation to the other firms in the industry.
Here it can be observed that only the equity ratio has shown good results, as everything else aside from the EBITDA coverage has done poorly. This means that the company has their assets funded mostly through debt compared to equity.
Putting emphasis on the poor performance of the TIE ratio of the entity, it can be said that the entity is less capable at paying interest on its debt. However, since PCPPI is one of the leading companies in the soft drinks industry, investors and creditors are still willing to invest in the company. Furthermore, companies that generate consistent earnings are more prone to carrying more debt as a percentage of total capital, encouraging investors and lenders to consider the company as a better credit risk.
For the profitability ratios, both its gross profit margin and operating profit margin performed within the industry range, which entails that the performance of the entity as to its normal operations is relatively same with other similar company. Yet, it must be emphasized that a greater part of its profitability ratios were identified to be below industry average. This includes the net profit margin caused by the large accumulation of interest expense. Return on assets, equity, and invested capital as well were significantly lower, which means that the entity is not efficiently managing its available assets and shareholders' investments to generate a high net income. Nonetheless, the company was still able to provide a good dividend payout ratio and retention ratio for the years.
PCPPI's price-earnings ratio is the only ratio classified as good among its market ratios. Its market book and dividend yield ratios are far below the industry averages. These reflect the good outlook that investors have in the future performance of the company, but also imply their low confidence on the company's current performance along with the low dividends it pays out relative to their stock's market price. Considering that other companies in the industry are better perceived by investors, it is likely that they will choose to invest in those rather than in PCPPI.
We can now summarize all the relevant interpretations and possible feasible recommendations based on our findings. It can be concluded that for the past 3 years, the entity has been highly dependent on debts to finance not only its operations, but also its current borrowings and capital expenditures. It is therefore recommended for the entity to consider relying on equity financing rather than on loans, as funds being mostly sourced from banks or other financial institutions would only add up to the growing amount of interest expenses paid.
Since it has been identified that the cost of goods sold accumulate the largest amount on sales, and as to why gross profit has significantly declined, it is suggested for the entity to reduce such costs, which may be done either through availment of purchase discounts or purchasing in bulk from suppliers to save up shipping costs and ordering costs. The significance of inventory management must not be neglected, and the application of techniques, including the economic order quantity or EOQ model, reorder point, and materials requirement plan, are highly suggested. The company may have it in their best interest to find ways to minimize their operating costs as their profit margin declines in comparison to industry averages from gross to operating to net profit margin.
On the other hand, the liquidity position of the entity being highly contingent on inventories and accounts receivable, where such assets have low turnovers, has also greatly impacted the entity to be less competent in the amount. The increasing amount of cash, in fact, is greatly contributed by their borrowings. With this, the entity may consider to lengthen its cash discount period or provide cash discounts to customers who will pay at an earlier date, if the earnings are greater than the cost of changing credit terms. The entity may also opt to have stricter credit standards, but if cost of implementing this method will exceed the savings, that the entity can improve its collection techniques through phone calls or personal visits if possible. The quicker cash conversion cycle would lessen the probability of the entity financing its operations through debts and have more cash be allotted for investments. The risk as well of credit customers defaulting payments and the entity incurring bad debts expense may be minimized.
Perhaps an analysis of more years would provide more accurate results and a clearer picture of the entity's position. The minimal amount of non-financial information has also enabled the researcher to analyze predominantly the company on a financial perspective. Thus, possible input from the operations side and other departments is recommended through an interview with the personnel or gathering data from these departments.
So this concludes our presentation. We hope we were able to thoroughly present this paper and highlight the concepts relating to the topics in AC FMG1. That would be all. Thank you for listening.